Understanding profit, a short primer from ockendontraining.com. There are three key learning points. Firstly, profit is not the same as cash flow. Secondly, it is actually possible to go bust whilst declaring profits. And finally, profit is actually an opinion rather than an objective fact. Let's suppose that I go into the TV business. I buy 10 televisions at £100 each. That's £1,000 spent. I sell 5 of these TVs for £200 each, so that's £1,000 cash received. My net cash balance is nil, but I have made a profit. To see why, just think about the fact that every time I sell a TV for £200 that costs me £100, I make a £100 profit. And since I did this 5 times in a row, I must have made £500 profit. However, we just proved on the previous slide that we had no cash. So where is the profit? I've still got 5 TVs though, and these are worth £100 each, since that's what I paid for them. So that's a total of £500 worth of assets, representing my profit. So my profit is in TVs, not cash. And that brings us to learning point 1. Profit is not the same as cash. Profit is about having a bigger business at the end of the period than you had at the start of the period. It may be that your cash assets are higher, but not necessarily. My sister goes into the TV business and she does things on a grand scale. She buys 15 TVs at £100 each, so that's a total cash outlay of £1,500. My sister now sells 5 of her 15 TVs for £200 each. She makes £100 profit on each one she sells, so that's a total of £500 profit in total. But she's got negative cash flow and therefore goes bust. Why, you may ask, does she go bust whilst declaring a profit? Well, the problem is that her profit is tied up in TVs. She has a total of £1,000 worth of assets in the form of TVs, but minus 500 of cash, since she spent 1,500 but only received 1,000. That leaves a net balance on her assets of £500, 1,000 less 500, and that is her profit. So learning point 2 is you can go bust whilst declaring a profit. Back to me again. Remember that I originally bought 10 TVs and sold 5, so I have 5 TVs left. These are worth £100 each, which represents my £500 profit. However, these TVs are stored in a leaky warehouse, and there's a rainstorm and they get rained on. It's tragically an uninsured loss. So what's my profit now? The pessimistic view would say that the TVs are worthless and can only be scrapped. My profit is thus 5 TVs, each of which is worth nothing, which is a total of 0. So all of my profit has disappeared in a puff of smoke. The optimistic view, on the other hand, would say the TVs are just wet and they can be restored. Whilst I might not be able to sell them for £200, I should at least be able to get what I paid for them. That's £100 each. And thus it's justifiable to claim that they are worth at least £100 each. Thus my profit remains £500. This leads us to the final learning point, which is that profit is ultimately an opinion. Are my assets actually worth what I paid for them? If not, what is an appropriate valuation? This is the sort of thing that accountants actually do, helping to form these judgments as to what the actual profit is. And strangely, it's really interesting. So in summary, profit is not the same as cash, because profit is measured in terms of assets and cash is just one type of asset. 2, it is possible to go bust whilst declaring profits, because your cash assets might be going down whilst other assets are going up. And 3, the size of your profit is actually an accounting opinion rather than objective fact. If you found this helpful, please find out more at ockendontraining.com.